Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, March 26, 2022, and this is my weekend update podcast. And what we're going to do today is, first of all, we are going to take a look at my current positions and my trades from last week. We're going to talk about when I entered the trades, why I entered the trades, how I am going to manage the trades going forward. I have trades on the daily charts, I have trade on the weekly charts, I have trades on the monthly charts, and so we'll go through all of them, and like I said, talk about when I got in, why I got in, and how I'm going to manage it. The most important thing, either to the upside or to the downside. After that, we're going to switch gears. We're going to talk a little bit about trader psychology, and discipline. Most important skill you can ever develop in trading. It really comes down to be able to create a plan and then follow the plan. You have to use good technical principles in creating your plan, but if you don't follow it, then what good is the plan, right? It's so important, everyone. I've been trading for 25 years. And if there's one thing I could get through, if I could get through to a new student, would be the ability to cut your losses quickly. Don't let your ego get involved. Cut your losses quickly. Be patient. Wait for a new setup with a good risk to reward ratio. And that's really what it is about. So I think I have some good things to talk about during the trader psychology section today. And so after we go through current positions, we'll get into that. After that, I always like to read a poem from my good friend Frank, and he writes poems, trading poems, great information. And I always like to highlight one of those. After that, we are going to go down through my watch list, each one by one. We're going to take a look at some current levels, and we're going to take a look at what positions I may be interested in for next week. Usually a position has to go higher or lower than where it is currently, but we'll go through each one. I'll mark the ones that I'm interested in, and hopefully that will be helpful for you. So that's kind of the plan for today. I hope you had a good week. We've had a nice rally in the market, and after such a big down move, we've had such a big up move. It's kind of crazy how just one-sided the market is, either to the downside or the upside, but that's the market, and that will change. But we're going to go through each one, see if I can find some good potentials for next week. Last week, the potentials that I was looking at really worked out well, and so it's nice to have a good positive week, especially after such a big down move. So that's the plan for today. I hope that's going to be helpful. I hope you had a good week. Put a little wind in your sails with the market going up. I know it's difficult when you go through drawdowns. There are a couple weeks there where swing trades were just not working, but they don't always work, right? But when they don't work, hopefully you're getting out quickly. When they do work, hopefully you're letting them work in your favor. So that's the plan. I have to run the U.S. legal disclaimer before we get started, so hang tight, and I'll be back in about 40 seconds. Thank you. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much. All right, thanks for holding on to that, and let's get started. All right, here we go. Gold, GLD. I did buy gold on March 23rd, earlier in the week. Bought it here at 181.51. This is a little bit different of a trading strategy than I have been highlighting lately. A lot of the trades in the past month, longer than that, have been deep dip buys. This is a new type of approach because the market structure has changed. So what you see here, this is a crossover trade. There's a 5. This little line here, this little light blue line is the 5 EMA. The darker, thicker blue line is the 20 EMA, and this is what's called a crossover. On the day that I bought it, the 5 crossed back over the 20 on a closing basis. You can see the previous day the 5 was below the 20, and then it crossed back over. So this is a good long-term back-tested approach to trading gold when the 5 finally crosses back over. And then there are rules to get out when the 5 crosses back under, so forth and so on. But I'll go through these a little bit more in detail. I don't usually just take any crossover. I like to take a crossover that has some sideways motion before the 5 crosses back over the 20. And you can see gold, we were way up, we came down, and then we had this sideways motion. Sideways motion consolidation leads to trends. That is just one of the facts about trading. Sideways motion leads to trends. We don't know whether the trend's going to be up. We don't know where the trend's going to be down. But nonetheless, the 520 crossover does backtest well, so I believe it gives an edge to the upside. We shall see. But it may break to the downside, in which case I will get out quickly. And that's it, right? I would get out with a small loss, and a loss that I knew beforehand what it was going to be, what my maximum allowed loss was going to be. If it runs to the upside, great. And that's the key to profitable trading, everyone, is keeping those losses small, letting the winners run, having a complete trading plan in place. You just can't let it run forever, right? You have to get in there and you have to manage the trade. There are certain levels, but I like this a lot. We moved up strongly. We had a bit of a retracement back into the value zone. The value zone is between this green line here and this green line here. Anything within this range, within this area, is called the value zone. I like to buy in value, sell above value. Most people like to buy above value, and then when it gets back to value, they probably hit their stop and they get up and they see it go right back up again. So the reason for this setup, nice move up, retracement back into the value zone, the sideways motion showing that there are buyers there, that there's some equilibrium, not just sellers. Here we just had sellers, but now we have equilibrium. We're building a base, we're building a foundation, and my entry trigger on this was the 520 crossover. In addition to that, we also have a higher low V2. Here is day 1, here is day 2, here is day 3. Day 2 goes below or washes out day 1. Day 3 closes above day 1, day 1's close, and that is what's called a V2 entry trigger. I like to, for my trades, I like Confluence's combination of indicators lining up, meaning that I want more than just one trigger or one reason to get into the trade, and that is why I took this trade, because of the confluence of signals, the 520 crossover and the V2 entry. So I have two lines here. You'll notice I have a line down here, 174.93. This is my emergency stop. If it gets down there, I'm going to go ahead and just get out of the trade. I have an amount that if I'm going to lose, I know my maximum allowed loss. And let me show you the math on this. So a good rule of thumb with position sizing, and it's very important to use volatility to help you on how many shares to buy, on what kind of position size that you want. The formula that I use is very simple. A good rule of thumb is 1% of your trading account. So if you have $100,000, 1% of that would be $1,000. So we'll just use that in this example. You take $1,000, and if you have a $50,000 account, 1% of that's going to be $500. If you have a $25,000 account, 1% of that is going to be $250. Okay, so Don't just go in there and use $1,000, right? It depends on what your account value is. But in this example, let's just use $100,000. 1% of that is $1,000. I always say position size based upon volatility. So take your maximum allowed loss, 1% of your total trading capital, in this example, divide it by the value of the 2 ATR. This puts you 2 standard deviations away from where you bought, the entry price of where you bought, and 2 standard deviations is 6.07. In this case, that's 2 standard deviations away from your entry. It should not get down there. If it does get down there, then you are seriously, seriously wrong. But in this case, $1,000 divided by 2 ATRs divided by 6.07 would tell me to buy, excuse me, 164.7 shares, or I just round up to 165 shares, right? So that's taking into account how much each day's range from high to low divided by 20. You add it all up, divided by 20. That tells you what the volatility is. So based upon this current volatility, taking my 1%, $1,000 in this case, from $100,000, and then dividing it by the 2 ATR here will tell me how many shares to buy. And so this perfectly calculates, based upon the current volatility, how many shares I could buy. So if I did go down $6.07 down to here, I would lose the $1,000, which is a small percentage of my capital. Now, that's my end of day stop. I'm sorry, my emergency stop. My end of day stop is if I get a 5 crossing back below the 20. That's the way you use moving average crossovers. Now, I do actually have a little bit different of a rule. Sometimes you can have the price close below both the 5 and the 20 EMA, but the 5 still being above the 20 EMA. So the way I'm going to manage this trade is, if the price were to close below both the 5 and the 20, if it closed below but the 5 was still above the 20, I would sell half my position. That's a little bit of a it's a red flag if the price closes below both the 5 and the 20, even if the 5 is still above the 20. If the 5 crosses back below the 20, then I will get out of the second half. Line up here, orange line up here, is 1.5 ATRs above my entry. If it gets to my trailing stop mode, the 1.5 above my entry, then I will go into trailing stop mode, which means if I have a close below the previous day's low, I will sell half, because that's a bit of a red flag. So that's the trade setup. Return to value, sideways motion, 520 crossover, V2 entry trigger, combination of indicators lining up for me. Position size by taking 1% of my total capital, dividing it by 6.07. That told me how many shares to buy. Place my emergency stop, again, the 6.07 below. If it ever gets there, I just get out. Doesn't matter what time of the day. Usually I'm an end of day trader. I make my buying and selling decisions for my end of day stops based upon the end of the day. But if it gets down to my emergency stop, all bets are off. I just get out, I take the loss, and then I look for a new trade in a different stock or a different market. But so far, so good. I bought this back on the 23rd at 181.51. And I am currently up 0.46% on the trade, looking good, and happy to have the trade so far. Next trade, Philip Morris. All right, I did take Philip Morris on the 24th of March. And why did I buy Philip Morris? Well, I bought it here at 92.48 last Thursday, and the entry triggers, the multiple entry triggers, were as follows. You can see this orange line here. This is the 300-day SMA. Previous day before I bought it, we closed under, then we closed back over. That's a close under, that's a close over of the 300 SMA. That does backtest well. In addition, we have another V2 here. Day 1, day 2, day 3. 2 goes under 1, 3 closes above. day one's close. That's a combination of indicators. Also, we had a MACD crossover. That's also another indication that the trend may be changing. And by the way, I'm talking about crossovers. I'm talking about V1s, V2s, in addition to the deep dip buy we have. I do have a YouTube channel. I have free lessons on there under the lessons playlist. Go in there, check that out. I talk a little bit more about, the V1s, V2s, crossovers, all my different entry signals. So if this is confusing to you, during this podcast, I don't have the time to go into just all the nuances and the details of all the trade setups. But if you'd like to learn more, check out my lessons video in YouTube. And then also, as you know, I do teach private one-on-one lessons in the evening time via Skype, where I teach all 5 of my different trading approaches step by step. So if that's of interest to you, just send me an email. We'll have a little Skype call. We'll get it set up. But I believe that the one-on-one trainings and the one-on-one course that I have is the best, total of 15 hours. But anyway, back to Philip Morris here. So again, close under, close over the 300-day moving average. MACD went positive. We have a V2 entry trigger in the value zone. Bought that last Thursday, and currently this particular trade is up 1.1%. Pretty good start. Of course, have emergency stop down here, trailing stop up here. Once I get up to the trailing stop, or if I get up to the trailing stop, then I'll go into trailing stop mode. But anyway, good little trade on gold. Philip Morris. Apple, well, this has been a monster trade. In the weeks leading up to the entry, I highlighted and I mentioned, I said, Apple is my favorite trade here. If I can get some kind of deep dip by bounce under the 200, back over the 200, that would be my entry signal. And boy, I got it, and it was a good one. Look, previous day before the entry had a close under, close back over the 200-day moving average. Really, really great. We also undercut the low of this range here. Usually a range is a 3-bar formation. A bottom range would have a low, higher low to the left, higher low to the right. This creates the range. The market came back down here, went under this low, tested it. There were no more sellers there. That's why we bounced back up. And so that is the formation of why I took Apple. Close under, close back over the 200-day moving average. We also had a V2. Here's day one. Here is day two. Day two washes out day one, closes above day one's close. We undercut the low. So lots and lots of indicators there. I did buy this back on the 15th at 155.50. Currently it's 172.74. Big trade, really, really big trade. And this particular trade currently is up 10.94%. Orange line here, my trailing stop level. So 1, 2, 3 days after I bought it, it did get to my trailing stop level. Doesn't mean I do anything with it. It's just that now if I have a close below the previous day's low, I will get out of half. But you can see after reaching here, did we close below here? No, we didn't. Did we close below here? No, we didn't. Did we close below here? No, we didn't. Did we close below here? No, we did not. So if I do now in the future get a close below the previous day's low, I will sell half. 63.37 RSI. If it gets up to 65 RSI, then the 5 EMA will come into play here if I get a close below the 5 EMA. Although this is so parabolic, it's such a move up. Actually, if it does not get to the 65 RSI level, since we're up near the third ATR channel, I probably will still use a close below the 5 EMA to get me out of the trade, because this is such a one-way market. Not complaining, very happy with it, up 10.94%. But we'll see what happens on Monday. We're at 63.37. If it gets to 65 RSI, that's normally when I bring in the 5 EMA. But because this is so parabolic, I certainly don't want to let this come all the way back down here. So in this particular case, if it closes below the 5 EMA at this point, after this huge move up, that would be a good indication that maybe we've stopped going up and we're probably going to go into some consolidation or so forth. But great trade on Apple. Beautiful trade on Apple, and most likely the next thing that would happen would be a close below the previous day's low, in which I would get out of half. Again, if it closes below the 5 EMA, I will get out of the full position. If it continues up rejects the 70 RSI, then I would get out of half the position as well. And then if I get a close below the previous day's low after rejecting the 70 RSI, then I would get out of the full position. But really great trades so far. SPY. All right. Well, this is a good example. I did buy SPY back here on the 16th of March, close under, close back over the 300-day moving average. MACD turned positive, adding a little extra cherry on top for the trade. So I did enter here 434.61. Of course, when I entered, I position sized based upon volatility, taking my maximum allowed loss, dividing it by the value of the 2 ATR, put my emergency stop down here. That's what that is there. Also put my 1.5 trailing from my entry above me at 440.70. You can see 1, 2, 3, 4 days later, I did get up to my trailing stop, and then the next day had a close below the previous day's low. So once I go into trailing stop mode, if I have a close below the previous day's low, that's when I sell half. So I did sell half for approximately a 1.99% gain. Locked that in. Market can't take that away from me now. And the second half continued to move up. That's why I like selling half. It's one of the only win-win situations you'll have in trading. If you sell half and it keeps going up, you're still happy because you still have half. If you sell half and it keeps going down, well, then you're glad you sold half. So it's one of the win-win situations. So the half position locked in a 1.99% gain, and then the second half of the position right now is currently up about 3.93%. One additional thing I want to mention, whenever I enter a trade and it moves 0.45 ATRs from the closing price, I sell 10% of my trades. So a lot of days I'll have one profit target, maybe two profit targets if it goes 0.9. But the point here is I like to play offense and defense with my trading positions. My stops to the downside's defense. If it moves up, then I take a portion off. Not all of it, but a portion. I'll take 10% of the shares that I have remaining if it moves a certain amount up, which would be 0.45. So in this example, you can see the 0.45 right now is 3.85. So for Monday, I'll take the closing price, 452.64. I'll add 385 to it. That will be my first profit target. I'll take the first profit target, add 0.45 ATRs to it again. That will give me my second profit target. Take my second profit target, add 0.45 ATRs to it again. That will be my third. And so for Monday, before Monday, I will go in here, do that math, put my three profit targets, 10% of my position size at each profit target, because I like to sell into strength and take a portion off. So anyway, half position here was locked in at 1.99%. The rest of the position up 3.93%. And of course, as it has been moving up, I've been taking off profits, but great trade so far. As with Apple, if we get to the 65 RSI level, then the 5 EMA will come into play. We're not as close to it as Apple, so it's still going to have to go up to the 65 RSI for the 5 EMA to come into play. Alternatively, if it keeps moving up, rejects the 70 RSI, I would sell half of what I have remaining, and then I would sell the remaining amount after the rejection of the 75 RSI with a close below the previous day's low. All right, okay. Now, those are the current daily open trades. Gold up 0.46, Philip Morris up 1.10, Apple up 10.94%, and SPY, the half, again, locked in 1.99% profit, remaining up 3.93% profits. So good trades there. Did have some bad trades as well. I bought LEG, Leggett and Platt, bought that here on the 18th of March. Nice V1 bullish engulfing bar, MACD was positive. Everything looked great. Bought this at 37.04. My stop on this is a close below halfway of the washout bar. You can see the very next day it closed barely below halfway of the washout bar, and I had to take the loss. And it is lower than when I sold it. It's always kind of a good feeling. So this one was a loss of 1.94%. Another loss that I had that I closed out last week was Home Depot. And this was kind of a big one. I did buy Home Depot here with an intraday rejection of the 300-day moving average, had a good risk to reward ratio, bought it at 330.74, and the next day, boom, just went all the way down. You can see I have my 2 ATR stop here. That would be my maximum allowed loss. I thought on that particular day I actually might trigger my maximum allowed emergency stop. Only happens about 5% of the time. The rest of the time, in my experience, about 95% of the time, it's your end of day stop. Well, this was my end of day stop. My end of day stop was a close below the 300 SMA. I bought the trade because it had an intraday rejection of the 300, and any close below, I'd have to get out. So there was news on the stock on that particular day. I think that had something to do with it, although it was a big down day in the market. Anyway, this one was a loss of 4.54%. Never fun, but looking back here, I'm glad I sold it because it's much, much lower. All right, so LEG, last week I locked in a 1.98% loss. Home Depot, much bigger loss, locked in a 4.54% loss. And so those are the closed daily trades. Now, I did have a couple weekly trades as well. I did buy Russell 2000 way back here, 128.22. We went under 30 RSI, over 30 RSI, reject the negative third ATR channel. That was my entry point. 193.20. You can see the orange line up here is my trailing stop level. Once I get there, I'll go into trailing stop mode. Not quite there, so I'm not quite at trailing stop mode. My end of day stop my end of week stop on this trade would be a close below the 30 RSI. Definitely not there yet, 46.05. This particular trade currently up 6.47%. So nice trade there as well. Another weekly trade that I took, and weekly trades, weekly bars end on Friday. And so every time we have a Friday, I take a look at weeklies. Didn't take a weekly yesterday because I do have quite a few positions, but I did buy Meta, which is Facebook, last Friday. What were the signals? Under 30, over 30 RSI, under the 300, over the 300. Bought this at 216.01. It is 221.82, and this particular trade currently up 2.86% on the week. And I really do like to trade different time frames. I trade all day long, day trading on smaller time frames. I take weekly trades. I take daily trades. I take weekly trades. I take monthly trades. I really like to have as many different positions going on in as many different time frames as possible. Sometimes one time frame will work, others won't. But I really, really believe deep in my heart that trading multiple time frames gives you the best cross section of the market, and that's why you see me trading daily, weekly, monthly. So this was a weekly trade executed on a Friday with a close of the bar under 30, over 30, and under the negative third ATR channel, over the negative third. Why is that important? Because 92% of prices tend to stop going down when you get to the negative third ATR channel. When they're under, I like to wait for them to close over, and you can see on that weekly it did. So the entry signal was a close under, close back over the 300, under the negative third ATR channel, over the negative third ATR channel. Bought at 216.01. Currently we're 228.84. And then what is going to be my end of day stop? Well, or end of week stop in this case, if we get a close below, back below the 300. Hopefully it just keeps on moving up, obviously, but it could close below the 300. If it does, I'll just have to get out, take a quick loss. Worst case scenario would come down here to my maximum allowed loss, and I would lose, you know, in the example that we had, 1% of total capital. If we have a hypothetical $100,000 account, 1% of that is $1,000. So if it did get down here, I would lose the 1%. But anyway, so far, so good, up to 0.86%. And then monthly, I do have a monthly trade here on Southwest Airlines. I bought Southwest Airlines, looks like almost 3 months ago. The combination of signals were as follows. We have a V2, here is bar 1, bar 2, bar 3, bar 2 goes under bar 1, bar 3 close over bar 1's close. Bought it at 44.74. We also closed under, back over the 100-day moving average. Here's my emergency stop down here. Do want to point out that this seems like a long ways away, and it is. It is approximately 36.31% below my entry. So does that mean if I get down there, I'm going to lose 36.31% of the trade? No, it doesn't. It really, all it means is I'm still going to only lose that $1,000 because I position sized, right? I took my maximum allowed loss divided by the really big 2 ATR value on the monthly, which is 1602. So don't let emergency stocks concern you with the percentages, because whatever your maximum allowed loss is, that's all that's going to happen. My end of month stop on this is my emergency stop. My end of day stop is, or end of week month stop is going to be halfway of the washout bar because I took it with this V2. If it closes under $42, that is my signal to get out of the trade. Well, you can see it was way below during the month, my stop of halfway of the washout bar, but I wait till the end of the bar to make my decision. Now we're back over. I bought this at 44.74. It's 44.38, still slightly down, but it was down significantly before and had the nice rally. So now only down 0.36%. So those are the trades. Good trading. Very happy with that. All right. So I said that we were going to talk about trader psychology, most important skill you can ever develop. This is from my good friend Steve Burns. This is the New Traders, Rich Traders podcast channel over on Facebook. It's a really, really good. I do want to highlight this for Steve. Steve is such a great educator, and just if you have not subscribed to Steve on Twitter, please do so. You can just look him up. Steve Burns, there he is. Hey, buddy. At S. Joseph Burns on Twitter. Do yourself a favor. He's been a coach, mentor, friend of mine for a long time now. Just a great guy, puts out great content. So please follow him at S. Joseph Burns. But let's take a look at this. Profitable Trading 101. Most people think everything is about signals, about technical signals of when to get into a trade and when to get out. And it is in a way, but big picture, look at this pyramid here. This is so true. Really, profitable trading comes down to having 10% put into this strategy. You notice that's the smallest amount because it's the least important. It's, trading, technical trading is really not that difficult. It's the emotional part and the money management part that's more important. So 10% strategy, 30% money management. What does that mean? Well, it means position sizing, keeping your losses small, letting your winners run. But you notice how 60% is the most important. That's you, my friend. That's you doing what you're supposed to do in the battle with yourself, not with the market, but with yourself. So profitable trading, it's 3 different important points to your trading. Yes, you need to have strategy for sure. You need to include money management, position sizing, good risk to reward ratios, getting out. But really, these 2 are all ruled by this, by the psychology of it all. So you have to create that plan. You have to follow that plan. Whatever it takes for you to follow that plan is the most important part of your trading. Now, Steve does have a great website over here called newtraderu.com. It's just newtraderu, the letter u.com. Here you can see it. This is a great website. And I was looking through this prior to the podcast, and Marty Schwartz, if you've never heard of Marty Schwartz is a market wizard, interviewed in the first Market Wizard book, and really liked his interview. But, Steve was talking about 10 trading principles that make Marty Schwartz a market wizard. And I went down here to Trading Psychology. I just want to read this. I mean, this is a market wizard, one of the best traders. And so when someone like that says something, I want to listen. But we're talking about trading psychology right now. We're talking about how important trading psychology. But let's see what Marty has to say. I've said it before, and I'm going to say it again because it cannot be overemphasized. The most important change in my trading career occurred when I learned to divorce my ego from the trade. Trading is a psychological game. Most people think that they're playing against the market, but the market doesn't care. You're really playing against yourself. You have to stop trying to will things to happen in order to prove that you're right. Listen only to what the market is telling you. Forget what you thought it was telling you 5 minutes ago. The sole objective of trading is not to prove you're right, but to hear the cash register ring. And it's so true, everyone. Ego is such a tough thing to deal with. You want to be right. I get it. I understand. I'm the same way, but I also want to be profitable, and that's more important to me to be profitable than to be right. So, when I have an end of day stop, I just get out, no questions asked. That's all it is to it. I'm just letting it go. I know there'll be another trade that's coming around later and one that will work. The last few weeks, swing trading was tough, but then again, I was saying, look, it doesn't seem like you're ever going to make another dime in the market, but I promise you will. And this week, we've gone up and it's been great, right? So profitable trading, 60% psychology, 30% money management, 10% strategy. That's the least important. What your mind is telling you and your actions, that's the most important. Money management, super important. And I know you get tired of hearing it, but position size yourself based upon the current market volatility. Have a good risk to reward ratios. Get out when you're supposed to. And the 10% strategy, it's important, but the least important out of this pyramid. So thank you, Steve Burns. I appreciate that. And again, follow Steve Burns over on Twitter at @SJosephBurns, and check out his website, newtraderu.com. All right, well, let's switch gears. Let's talk a little bit about Frank's poem. This is Frank. Love Frank. When I used to have the live stream podcast, he would come every day, write a poem for us. Just fantastic, and always pertinent to what's going on with the market. But I like this one. Let's take a look. And remember, follow Frank at FrankOD over on Twitter. Today's market poem. There's always that gamble when markets are unstable and make you scramble. Mixed messages from the media become a ramble, stepping on even the best setups in a trample. Oh, what a trader goes through, and that's just a sample. So true. I don't like to say trading's gambling. I like to say you have to find your edge there, but it's challenging sometimes. It really is. Markets, sometimes they're stable, sometimes they're unstable like they have been. Mixed messages from the media. We have this war going on, but the market's going up. Always interesting. Stepping on even the best setups is a trample. Yeah, I've had some really good setups in the last few weeks that I thought were great setups. They didn't work out. Luckily, I got out quickly. But oh, what a trader goes through, and that's just a sample. Trading is not easy, everyone. It is tough. If it were easy, everyone would trade in their pajamas, make a lot of money, and that's not the way it is. You're dealing against some of the most the smartest people and machines in the world, but you do have an edge. You do have an edge. As a retail trader, you have a major edge because you can get in and get out quickly without affecting the market. So there is advantage for you to be small traders, and that's just being able to get in and get out whenever you want. Large financial institutions, they can't do that. There are certain areas that they have to get out, otherwise they're going to move the market. So that's the good news. So thank you, Frank. Appreciate that poem. Hope you're doing well, and we'll look forward to your poem next week as well. All right. So what we're going to do now is we are going to go down through my watch list, each stock one by one. If I find something that looks like an interesting trade that potentially might happen next week, I will mark it and I'll explain why. And the market formation that we've had recently, I don't know if there's going to be a lot of them. I'm not saying I'm doing this fresh right with you, but usually the market is either going to have to go up a bit for me to get interested, or it's going to have to go down a bit. So hopefully by watching this, going through this, you kind of get an idea how I think and look for setups. So let's get started. Apple. All right. All right, well, I'm in Apple, as you know. It's really quite extended. I would not be chasing this for a new trade here. So I really don't see anything on Apple other than the 5 crossing back under the 20 and then crossing over. Doesn't look likely for next week. I'm just going to mark the ones that look potentially likely. Adobe. Well, where we're at with Adobe does not look promising to me. We're 43 RSI. If we went under 30, over 30, yes, that would be interesting. Some kind of crossover to the upside, but it doesn't look likely, so I'm going to skip. AGQ, this is double leverage silver here. The trade already happened. That's why I took gold, because it also had a 520 crossover. I really don't see anything on this other than if the 5 EMA crosses back under the 20 and back over, that might be interesting. So we will mark that one. AMD, big move here on AMD. Boy, there were some good entry signals back here on AMD. Under 300, over 300. Next week for AMD, if we were to come back, retest the 200-day moving average intraday, or close under, close back over the 200, that would get me interested, so I will mark that one. Amazon, don't really see anything here. You might say, Greg, what about if we break over the 200? Yeah, but the levels that we're at right now with the 200 are really extended. You can see this is the 3rd ATR channel. I don't buy anything over the 2nd ATR channel ever, because 92% of prices fail at the 3rd ATR channel. And so far, this is exactly what Amazon has done. So yes, it could close back over the 200. Doesn't mean it can't continue up. But statistically, I don't want to buy something up here, so I really don't see anything on Amazon for next week. ARC Innovation, really don't see anything here either. I really don't, although let's back test. Let's see. This is ETF replay. I'm using this by permission. And let's see, ARKK. ARKK. Let's see, we'll go exponential, we'll go daily, we'll do a crossover with a 5 and 20 EMA crossover. We'll see how that back tests. That might give us an idea. And it does back test well, 230% compared to 248 on the buy and hold, but the drawdown was only 28.7%. So yes, that makes sense. It's not a buy right now. The 5 is still above the 20, but if we were to have a close of the 5 below the 20 and then back over, that might be interesting. So I will mark ARC after checking that back test. Boeing, 5 is under the 20. Let's check Boeing for a potential crossover. Let's just go back to here, put in Boeing. Yes, 520 crossover does backtest well on Boeing. I like it, and I especially like it because of the sideways motion here on Boeing. So yeah, very likely because of the sideways motion and we're in the value zone. If we have a 520 crossover, which could happen as early as Monday, that would be interesting to me. So I'm going to go ahead and take that, or mark that. I don't see anything here on Alibaba. Boy, what a big move down and what a huge move back up. I really don't see anything on Alibaba for next week. Berkshire Hathaway, just going like crazy, but way too extended. Doesn't offer a good risk to reward ratio, so I don't see anything here. Bitcoin, been doing really well. Did well with the 520 crossover, and it has really moved up nicely. I don't see anything next week that looks interesting to me for Bitcoin. Budweiser, don't see anything here that really gets me too excited. Beyond Meat, nice move up here, but no, I don't see anything on Beyond Meat lightly. Caterpillar, boy, big move. Yeah, if it came back down to the 200-day moving average, that would give me a good risk to reward ratio, but don't see that being likely. So I'm going to skip. Cameco, don't see anything likely. Move back down to the 200 would offer a good risk to reward ratio, but it doesn't seem likely. Carnival, I was actually looking at Carnival last couple days here. Here we have, this would have been a valid entry signal here. This is a higher low V1 entry signal. Again, you can go into my YouTube channel. I have a specific video about V1s and V2s. Big part of my trading, and so that video I think could help you out. This would be a higher low V1. Here's day one, day two, two washes out, day one closes above. That's a valid entry signal, but I didn't take that one. I took something else on that particular day, but I really don't see anything right here for Carnival. DoorDash, of course, we've had the big move up, pull back to value, some kind of V1, V2, but it's not specific enough, so I'm not going to mark that. Dow Jones Industrial, well, we close back over the 250, which is a good sign. We have a lot of overhead resistance here at the 200. Doesn't mean we can't get up above it, but I really don't see anything on the Dow that interests me. If we do get above it, it's going to be above the second ATR channel. I don't buy anything ever, I don't care what, above the second ATR channel, so nothing on Dow Jones. Disney, very nice sideways motion here on Disney. Let's check Disney on the 520 crossover because that does look like it's something that may happen next week. We run the back test. Yes, it's positive, not very positive, 57.7, but yes, it is positive, so it does show that it's an edge. I specifically like the sideways motion here. So yeah, I will mark Disney. That does look likely if the 5 crosses back on a closing basis over the 20, especially in the context of the sideways motion, MACD being clean. So yes, being green. So yeah, I will mark Disney. DocuSign, I don't really see anything here. Etsy, let's try Etsy over on the 520 crossover, see how that back test, that could be possible. Yeah, it does back test positively. Not a lot compared to buy and hold, but it does make sense. I don't know if this is going to trigger, but I will mark that because if it were to go back over, I may have an interest in that. Meta, Facebook, of course, I already bought Facebook on the weekly charts, not on the daily. On the daily, looks extended, so I don't really see anything here on Facebook that looks likely. FCX, commodities doing really well, extended, not interested. Fiverr, don't really see anything there either. Gold, of course, I did take gold with the 520 crossover again. My opinion, the best crossovers happen when you have sideways motion. We did have sideways motion already in the trade, so I'm not going to mark that. GNRC, don't really see anything there. Google, boy, what a great buy for Google with the close under over the 300. Similar to Apple, it's moved up here. It's extended, in my opinion, could go higher. If we were to come back test the 200, that would be a decent place to enter Google with a good risk to reward. So I will mark Google if we get a pullback and bounce at the 200-day moving average. Ideally, I'd like to see this bounce back at the 250-day moving average. That would be about a 50% retracement from this low to this high, in addition to the support of the 250. So depending on the formation, yeah, if it gives me a good risk to reward ratio off the 200 at the lower levels with the support of the 1 ATR channel, that might be interesting. Ideally, a pullback to the 250. So I did mark Google. Goldman Sachs, well, look, we have a 520 cross under. If it were to cross back over, that would be valid, just as long as it does back test well. So let's back test it and see. Yeah, really nicely positive, big time. So for sure, I'm going to be marking Goldman Sachs because we do have the sideways motion. The 5 is under the 20, so the 5 cross back over the 20. That would be interesting to me. Home Depot, well, under 30, over 30 would be interesting. We're at 35.17. So yes, if we went under 30, over 30, that would be definitely an interesting place for me to buy Home Depot. It could certainly happen. I did have that losing trade, but you know, I guess it's a good time to mention if you have a losing trade and then you get a re-signal, most of the time from a human standpoint, you don't want to take it again, right? But sometimes it's the best thing to do. So yeah, if Home Depot goes under 30, over 30 down in this area, I would be interested. We would also have a double bottom with a bullish divergence here. So I'm going to mark Home Depot if we go under 30, over 30 RSI. IBB, I don't really see anything there. INDA, nope, I don't see anything there either. Intel, boy, what a big run Intel has had. Look, it closed over the 200-day moving average. Is that an entry for me? Well, it could be if it were at lower levels, but now we're at the third ATR channel. 92% of prices fail here. Doesn't mean it can't go up, but from a statistical standpoint, more likely it's going to go down than up. Not interested in Intel. IWM, well, I already have IWM up 6.47%, but on the daily chart, I don't see anything that's likely for next week. Johnson & Johnson, a pullback to the 200 would be good, but I think that's asking a lot that we're going to go all the way back down there, so I'll skip. JO Coffee, I might be interested in coffee. We have a nice confluence here. Sorry, let me grab a drink of water. I'm losing my voice. We have a nice confluence here of the negative third ATR channel and the 200-day moving average. That would be a nice confluence of support there and the previous low. So yeah, I'll mark JO for sure if we can get down here, but only if we can get down to that area and we can reject. So good one there. CarMax, don't really see anything here on CarMax. I know they have earnings coming up next week. Coca-Cola, boy, big rally off the bottom, but I don't see anything likely for Coke. LMT, Lockheed Martin, pulled back into the value zone. Now we have this kind of up move here. Don't see anything likely there. Southwest Airlines, I already do have Southwest, but on the daily, I don't see anything likely. Lyft, let's check Lyft on a 520 cross under and back over. LYFT, let's try Lyft on the 520 and see what the back test shows us. Negative 23.3%. So 520 crossover has not shown in any type of edge. So that's why I like to use this ETF replay for that very reason. So yeah, even if the 5 crosses under and then crosses back over, I'm not going to take it because I back tested it and it does not show positive expectation. MasterCard, well, 520 cross under, cross back over. Let's check MA on the 520 and see what it has to say. Yeah, it does back test well. So right now the 5 is above the 20. It would have to cross under and cross back over. So yes, I'll mark that one. McDonald's could get above the 200-day moving average, but it would be at the second ATR channel. Too big, too extended for me after this big run, so no. Merck, wow, Merck, really great move up. But I don't see anything likely on Merck. Morgan Stanley really moving sideways. You know, I told you earlier that sideways motion leads to trends. This is a lot of sideways motion for sure, but I think I'll skip that one. Microsoft, well, holding above the 200-day moving average. I will mark Microsoft. I don't think I would buy it at that 200 up there, but if we did next week come back down and test the 250-day moving average right in the value zone, that would be of interest to me. So I did mark it. Netflix, don't see anything there. Nike, don't see anything there. Nvidia, wow, look at this trade with the close under, close back over the 250. That has been a monster. Not going to chase it up here. It's already had a big run. I'll mark it though for next week. If we were to come back, retest the 200-day moving average, that would be interesting. That would be about a 50% pullback from the low up to the high here. I don't know if it's likely, but if it does, I would be interested. So I'll just put it there. I'll mark that one. Pfizer, don't see anything on Pfizer. PKI, nice little intraday rejection of the 200. That would have been legitimate. It was down on an up day, so I'm going to skip that. PLTR, don't see anything there. Philip Morris, of course, I already had the Philip Morris trade. MACD went positive. Close under, close back over the 300 in the V2. That's why I have it. PayPal, I don't see anything there. Q's. Q's had a beautiful 520 crossover right here that would have worked out well. Don't really see anything likely on Q's to extended. Rio, boy, excuse me. I want to congratulate my trading partner, Ava. She had a great trade on Rio. Look at this bounce at the 200-day moving average. Gave her a good risk to reward ratio. Also confluence of the negative third ATR channel. And it just rock and rolled all the way up. Way to go, Ava. But as far as the new trade for next week, I don't see anything for me personally. Shopify, glad to see Shopify up. I know a lot of people own that, but I don't see any particular trade likely for next week. SIVB, not much there either. Silver, no. Snapchat, no. Virgin Galactic, don't see anything there, but nice move. S&P 500, well, I already have this trade, so I'm really not looking for anything. I'm just managing the trade currently, but as far as next week, you know, if it were to come back down, test the 200-day moving average, and I didn't have SPY, that might be interesting. Like a lot of the stocks that I've been talking about today, for me to seriously get interested in them, I'd like them to come back to about halfway of this move. We have a low, we have a high. Like a bounce at the 300-day moving average would be fantastic, but I don't see that as likely. Teladoc, no. Teradyne, nothing likely. Bonds, well, my gosh, bonds have just gone down. This is TLT. An under 30, over 30 RSI next week. I don't know if it's likely, but I would get interested, so I'll mark that. Tesla, big move up. We're up near the third ATR channel. 92% of prices fail here. Yes, pull back to the 200, you bet. I'd be interested in Tesla, but I don't see that as likely, so I'm not going to mark it. Twitter, don't see anything there. Unity Software, I don't see anything there either. United Airlines, nothing looks likely there. Natural gas, woo, taken off like crazy. Too extended, I don't see anything there. United Healthcare, same, nothing. Oil's been a big mover here. Look at this. Came into the value zone and bounced. Very nice, but I don't see anything likely right now. The dollar, nothing likely. VIX, well, VIX is a wild animal. Of course, VIX's volatility. Well, I mean, talk about volatility. Look how high. I remember this day Ava and I were trading. I was like, I can't believe it was like $10. Came all the way back down. We are holding the 200-day moving average, which is kind of an interesting situation. If I could get some kind of close under, close back over, V1, V2 entry, I may be interested in VIX for next week, so I will mark that. Verizon, no. Walgreens, don't see anything in there either. Walmart, maybe a retest to come back down, and the retest of the 200 would be interesting. Energy came to the value zone and bounced, as it often does. Don't see anything there. XLF, really nice trades here with the deep dip buy trades with an under 300, over 300, but this is way too extended for me, so nothing there. Real estate, finally closed back over the 200-day moving average, but that does not backtest well, so not interested. XLU, great, nice move up. Don't see anything likely for next week. Healthcare, nothing likely. Exxon, no. And Zoom, no. So let me go in here and mark the flagged symbols. And don't have a lot. What do we have? About 16 for me to look at. AGQ, next week, if we were to have a 520 cross under and then back over, that would get me interested in AGQ, but only if the 5 closes under and then it closes back over the 20. So don't know how likely that one is, but something to look at. Advanced micro devices, yes, been very strong. If we were to come back and test the 200-day moving average, that would give me that I would be interested in that trade. But if and only if it rejects the 200 and gives me a good risk to reward ratio. ARC, if the 5 crosses under the 20 and then back over, that would be interesting for me if it happens anytime next week. Boeing, I quite like Boeing because the 520 crossover has not happened yet. That would be a legitimate entry, but I love the sideways motion. I love the consolidation. I just look now that I have the consolidation in the value zone, which is exactly where I want it. A 520 crossover is what would get me interested in. So I quite like Boeing next week with a 520 crossover if and only if it happens. Disney, 520, same with Boeing. I like the sideways motion. If we get a 520 crossover, that would be my signal. Etsy, 520 cross back. It's under now. The 5 is under the 20. If it closed back over, that would be interesting. But I like Boeing and Walt Disney a lot better. Google, if we were to pull back to the 200-day moving average and it gave me a good risk to reward ratio, that would be one entry for me. Also, the more ideal entry would be a deeper pullback to the 250. So I'll be watching that next week. Goldman Sachs, yeah. The 5 is under the 20. The 5 EMA is under the 20. If we could go back over, that would be my entry. There is some sideways motion here, but more movement. I mean, look at Goldman Sachs here. Yeah, it's sideways in the main, but there are bigger moves here. I mean, if we go back over to Boeing, see the real sideways motion. If we go to Walt Disney, see that's even more sideways motion compared to Goldman Sachs, a little more sideways motion, but a 520 crossover on Goldman Sachs would get me interested. Home Depot, I really would be interested at Home Depot if we went under 30, over 30. We're at 35.77, so it does have to move down further and then back over me to be interested in. But if there's a chance that happens, yes, I would try Home Depot again with an under 30, over 30. JO. Pull back to the 200-day moving average. Doesn't look likely, but if it does, I want to be there watching it. MasterCard, if we had a close, if the 5 EMA closed under the 20 and then back over, that would be of interest. But both of those things have to happen first. Microsoft, depending on the formation, if I get another chance closer to the 200-day moving average, might have an interest in Microsoft, but really where I'd love to buy Microsoft is a pullback to this 250. That's really, and of course the 300, but I don't know if it's going to go there. Nvidia, well, a pullback to the 200 would make sense. I don't know if it's likely, but it's a big mover. I guess it's possible. But yes, if we pull back to the 200. Bonds, if I could get an under 30 over 30, it's 36.24. Doesn't mean it has to get there, but at some point I'm sure bonds will put in a bottom, but only if it does. At the 30, VIX, if I had to close under the 200 back over the 200, that would be interesting for me next week. Ideally V1, V2 for a confluence. And then Walmart, yeah, a pullback to the 200 would make sense. So yeah, the market has been extended. And so a lot of these potential entries for me are I'm looking for some type of pullbacks other than the Boeing and the Walt Disney, looking for a 520 crossover. So, I mentioned earlier in the podcast that now I'm talking about V1s, V2s. I'm talking about moving average crossovers, double bottom bullish divergences. For the last few weeks, I've basically been talking about deep dip buys because that was the structure of the market. But, if you're like, Greg, I don't quite understand all that. Like I said, there's a couple options. One, you can go to my YouTube channel, take a look at the lessons playlist. I talk about those in there. Hopefully that's helpful. But ideally, the best way to learn really anything, whether it's trading or guitar or violin or swimming or whatever it is one-on-one with your teacher or your mentor. And that is why I do offer private one-on-one lessons in the evening time via Skype. I love to teach. I've taught people from all over the world. I am good at it. In the course, I teach you all 5 of the different trading approaches that I use. I teach you how to position size for volatility, place your emergency stops, end of day stops, profit targets, overhead resistance levels, trailing stop methodologies, and it's a great course. So if you want to be a better trader, I promise you the best way, in my opinion, would be to do a one-on-one course with me. The course is a total of 15 hours, 5 sessions. Each session is 3 hours. That's where you get your 15 hours. The cost is $1,750. Sounds like a lot of money, but I promise you it's worth every penny. You are really getting a steal to be able to work one-on-one with a coach for that many hours, and it's the best way to learn. I promise you. And I put a lot of effort into my teaching. It's very important to me that my students succeed. So if you're interested, you'd like to do that, you want to develop a skill and you want to have someone that can watch over you and really teach you step by step. I throw a lot of questions at you. I try to mix you up a little bit because I really want to make sure you have it, because again, it is important to me that my students succeed. So if you're interested, there is an email in the link of this YouTube video. Just send me an email, reach out, say, hey Greg, potentially interested in doing the one-on-one course with you. I'll write you back and say, hey, that's great. Let's set up a Skype call. The Skype call is free. It's not a sales call. I promise you. I just want to see if we're a good potential teacher-student match, really. It's not a sales call. I just want to learn more about you, your trading challenges, your trading goals, and it's a great time for you to ask me any questions about the course while we're on the Skype call. And then when we're done with the Skype call, you can think about it as long as you want. If one day you decide, hey, today's the day, I really do want to take these lessons with Greg, just email me. We'll set up a time, we'll set up a date, and away we will go. And I promise you, you'll be glad you did it. Secondly, I do have a great online video course over at udemy.com. I teach you the deep dip buy stock trading strategy. I have sold so many of those courses around the world, such good feedback, so many good reviews. It's a great course, and the best thing about it, it only costs somewhere between $12 and $15 depending on the day on Udemy. And there is 9.5 hours of video. There are 26 videos. There's 15 study guides, and I teach you step by step how to trade the deep dip buy approach with position sizing, all the things we have to learn. And you can see some of these deep dip buys have performed very, very well. So if you're interested in taking that course, the link is in the description of this YouTube video. And then lastly, if you like today's podcast, I really would appreciate it if you could hit the thumbs up button. It helps to build the channel, helps to keep the channel around, lets YouTube know that there's some valuable content here. And, if you could share it on social media, that would be great as well. But if you did learn something today that was helpful at all or in past podcasts, if you could hit the thumbs up button before you get on with your day, I would just sincerely appreciate that. So that's all for this week. I hope you have a nice weekend. Hope you get some exercise, do some deep breathing, maybe do a little meditation, but just do something healthy and happy. And I hope you laugh. I hope you're safe. I hope you drive safe. I hope you spend some time studying your charts. And I really appreciate you being here. So, if you have any questions, you can leave them in the comments below. But I wish you a good weekend, and I wish you a good trading week next week as well. All right, take care, everyone. And on the way out here, I have to run the U.S. legal disclaimer. Thank you, and hopefully we'll see you next week. Bye-bye. U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.